今天我们想跟大家聊一聊最近在摩根士丹利亚洲投资会议上面大家都在热议的几个话题，比如说全球央行的最新政策走向，亚洲的这个工业投资的新趋势，还有新兴市场股市的一些投资机会和风险，以及中东地缘局势对油价和日本的一些板块的影响。
这几个话题确实都非常值得关注，那我们就直接开始吧。
首先我们要讨论的是全球央行的政策路径，那这个美联储最近的这个利率政策有什么新的动向，然后背后是哪些核心因素在影响他们的决策。
这次会议呢，美联储是彻底打消了市场对于2025年9月降息的幻想。现在最新的点阵图是指向2027年的第一季度才会开启降息。那这个主要的原因就是因为美国的经济实在是太强劲了，然后通胀的回落呢还需要更多的数据来证明。对，而且有3位委员已经不赞成继续宽松了。另外就是油价的这个冲击呢，其实到目前为止只是影响了消费者的可支配收入，对核心通胀的影响其实是非常有限的。
明白了。那日本央行和欧洲央行他们最近在货币政策上面又有哪些新的动作，然后他们现在面临的难题又是什么？
日本央行呢，在4月份的时候还是决定把利率维持不变，但是他们暗示可能会在6月份进行加息。然后他们对于油价的上涨呢，是认为会拖累经济增长，而不是会推升通胀，所以他们的政策节奏暂时也没有什么大的变化。那欧洲方面呢，欧洲央行和英国央行其实他们都面临着一个很棘手的问题，就是2025年的经济增长预期已经被砍到了 0.5%， 然后同时呢，他们又受到了油价的这个剧烈冲击，所以他们就是在抗通胀和保增长之间左右为难。
没错。
所以虽然市场还在预期他们可能会再加息，但是其实经济下行的风险已经非常高了。
没错。那我们下面就来说说亚洲的工业超级周期，就是这一轮投资热潮到底有多大的规模，然后它背后的核心的增长动力到底是什么？
亚洲现在这个工业投资啊，真的是非常非常猛，已经从11万亿美元，预计到2030年要涨到16万亿美元。
对，
而且每年的增速是 7%， 这其中呢有4个领域是增长最快的，就是 AI、能源转型和能源安全、国防还有全球供应链的重构，这4个领域是增长最快的。而且这4个领域加起来的话，到2030年是要从 5.5 万亿美元涨到 8.7 万亿美元，年均增速是 10%。
这么多啊！那哪些亚洲经济体是最有可能在这一轮工业超级周期当中受益的？然后他们会分别是通过出口还是通过内需来实现增长呢？
出口导向型呢，就是中国、韩国、日本、中国台湾这几个是最直接受益的。那印度的话，它是因为国内的这个资本开支的周期非常强劲，所以它是主要靠内需来拉动的。
明白了。那这个中东的地缘局势的紧张和油价的大幅波动，会给亚洲的工业周期带来哪些短期的扰动呢？
因为中东的这个地缘风险和油价的上涨，已经让亚洲今年2季度的工业增速有一个明显的下调。然后预计这种影响可能会持续到3季度。那如果说后面这个冲突有所缓解的话，整个亚洲的工业周期应该是会有一个比较有力的反弹。
那我们接下来要关注的就是新兴市场的股市了。为什么现在不认为新兴市场整体会有一个长期的牛市？
主要是因为新兴市场它没有一个统一的宏观的叙事，然后它的这个地缘政治的风险又一直很高，再加上它的这个市值和盈利都非常集中在少数的几个市场和行业，比如说半导体和 IT 就占了 35%。所以你如果是去被动的追踪一个指数的话，其实效率是很低的。
对。
然后新兴市场整体的估值也不便宜，它的投资回报率也没有办法明显的超越发达市场，而且它的盈利波动又特别大，对油价又特别敏感，所以它的整体的风险调整后的收益是比不上美元信贷或者是铜这样的一些替代资产的。
那如果是这样的话，在新兴市场里面投资有什么特别的策略是比较值得推荐的吗？
大家最好不要去再死盯指数了，而是要去精挑细选个股。比如说像一些机构已经通过这种精选20只核心股票的组合，就可以每年跑赢基准300个基点以上。
那这个中东的地缘局势如果恶化的话，会主要通过哪些渠道影响到日本的市场？然后哪些行业会首当其冲？哪些行业可能会相对抗跌一些？
这个风险其实主要是通过3个途径，一个是成本的上升，一个是供应链的受影响，还有一个就是需求的减弱，这3个途径来影响日本的市场。那最容易受到冲击的就是交通运输、能源还有汽车这几个板块。相对而言的话，建筑板块的防御性会好一些， 因为它的风险已经基本上被市场消化了。
最近日元的汇率波动也挺大的，那现在这个美元日元已经到了160以上了，日本央行会出手干预吗？
目前来看的话，在160以上，央行出手的可能性还是不高的。
对，
因为现在日元的空头仓位只有2024年夏天的一半，所以其实现在日元的贬值压力是比那个时候要小的，是可控的。
好的，我们再来讲讲几个关键问题的问答环节啊，就是为什么美联储这一次这么坚决的把降息时间点推后？
他们主要还是看到美国的经济比大家想象的要坚挺，然后通胀虽然说已经不再创新高了，但是还没有出现可以让人完全放心的持续下行的信号。
对，
所以他们就需要看到更多的实实在在的数据。另外呢，就是有一些委员是担心过度宽松会带来新的风险，所以他们就宁愿再等一等，把降息的这个事儿再压后。
那亚洲的这个工业超级周期背后到底是哪几股力量在起作用？
这个主要就是4大动力，一个是 AI 和它相关的基础设施的投资，第二个呢就是能源转型和能源安全所带来的大量的支出，第三个是因为地缘局势的紧张推动了国防装备领域的开支，最后一个就是全球供应链的重构带动了整个亚洲资本品的需求。
原来是这样啊！那为什么新兴市场股市整体来看并不是一个很好的长期的配置选择？
新兴市场其实它是一个非常分化的市场，就是它没有一个大家都共同向上的这样的一个基础，然后同时呢，它又受到地缘风险的困扰，个股和行业的集中度过高，所以你如果是去买一个指数的话，很容易就会踩雷，或者说错失机会。再加上它的整体的估值又偏高，然后盈利又非常的起伏不定，所以它的这个风险调整后的回报经常还不如一些美元信贷或者是大宗商品来的划算。所以说你一定要去精挑细选，而不是说去盲目的去追这个整体的行情。
对，今天其实我们把全球主要央行的最新的动态，亚洲的工业投资的新的趋势，新兴市场和日本股市的一些机会和陷阱，我们都给大家梳理了一遍。
是的，那这期播客就到这里啦，感谢大家的收听，那咱们下期再见吧，拜拜，
拜拜。
Good morning and good afternoon, everyone. It is April 30th, Thursday. Welcome to Morgan Stanley Asia Macro Webcast. My name is Crystal G, Asian EM Market Strategist. Before we start, please note that this event is for Morgan Stanley institutional clients and financial advisors only. It is not for members of the press. If you're a member of the press, please log off and reach out separately. Please also note that this session and your questions may be recorded. Today we have Chetan Iyer, Chief Asia Economist, Rajiv Sibal, Senior Global Economist, Jonathan Garner, Chief Asia and EM Equity Strategist, Sho Nakazawa, Japan Equity Strategist. During this podcast, you can send your questions at any time from the Ask a Question text box. We had the FOMC meeting yesterday, and then today we have our global economist, Rajiv, to share his reads and also to share the global central bank's policy path. Over to you, Rajiv.
Hey, good morning, everyone. I will review what has become Central Bank Week. We've had 2 of the 4 major G4 economy policy decisions come through already, and then we've got 2 more today. And so if I think about what's happening, we started with the Bank of Japan. The Bank of Japan announced hold, but the indications felt pretty clear that June has to very much be on the table. This was in line with the Morgan Stanley view that April would not be a live meeting and that June would be the meeting for a potential hike. I think the point being in that the Japanese central bank did not feel like they needed to shift their pre-orchestrated timeline or their thought process around the oil supply shock. And in fact, that the oil supply shock is probably more of a growth risk than it is an inflation risk in the Japanese context. There's some nuance there, and there's differences of what that means in terms of nominal growth to the real economy. But from the central bank standpoint, they maintain a course that we had forecast preceding the oil shock. The Fed came out yesterday and surprised us a little bit. We continue to think that there's some growth risks ahead of us, particularly in Q2. The disposable income impact in the United States will be manifest in Q2, but it probably doesn't persist for the entire year. That had been our call. What's different, and we've changed our call overnight for those of you that follow and we're taking that out and pushing that cut to 2027. I think the path of the data that we forecast is not changed that much. The difference is that the perception of that data has changed, particularly with the dissents from the Federal Reserve, with 3 dissenting members indicating that they're not comfortable with an easing bias at the current moment in time. Let me go through a little bit of that detail and explain what we think is happening. The reason we had originally left September on the table was because in June, you're going to have a number of catalysts, particularly on the inflation point, that we thought might indicate that we were at peak inflation. The first one is that in the United States, the Section 122 tariff arrangements legally expire in late July. And so we will get some replacements. We've published about this very recently. The Section 301s and Section 232s should be out by June. And while they won't be finalized, it should give some level of clarity as to what the tariff rate is going forward. And our baseline expectation is that the tariffs do not go up, but are rather maintained around that 10 to 12% level. As a result, inflation could start to turn lower from that May-June timeframe onward. The second thing is that we should have clarity around USMCA, which is another trade negotiation going on with Mexico and Canada. There's a high probability that that trade negotiation does not come into force or does not get renewed in July, and that perhaps it gets pushed out for negotiation later. In that scenario, the previously mentioned tariffs become the baseline, and again, you get more certainty around the tariff path and what that means for inflation. The third thing is that June will be Kevin Warsh's first meeting, and with the market not pricing any cuts, we thought maybe that the risk-reward skew there could be that he says something that is a little bit more balanced. So for all these reasons, and additionally, actually, the oil price shock, which usually has a 3-month lag to core in the United States, and statistically in the United States has a very limited impact on core, which in our estimates right now is more in the kind of low teens range, that all of these things become apparent in June or July. And so we thought at the peak of inflation pressures in the United States at core, once you got clear signaling that we could be moving lower into year end, that the Fed may be able to signal an easing bias into the acute fourth quarter of the year. What we've discovered is that that's not going to be enough. We're seeing that the perception is that the U.S. is already kind of near neutral given the strength in the economic growth, that disinflation needs proof. And so that proof means that they don't only want to see the peak of inflation, but they want to see the lower prints. And that's the reason why we're delaying our cuts from that September fourth quarter area until the first quarter of next year. The implication is that the Fed, there's always an accusation that the Fed is sometimes behind the curve, but they're doing that purposefully this time because the strength of the economy and because of the elevated inflation. They don't just want to see that inflation is turning, but they want to see that it has already turned. And so that's the reason why we're pushing our call to the new year. It's in line with market pricing. The market pricing moved into this. Market pricing had been indicating an easing bias in Q4, and that's now pushed out. And that's basically what is happening here. Today, we get the ECB and the Bank of England. Both these central banks are in a much more difficult predicament than the market or than the Fed or the BOJ. I think the point here is that while we went into the Fed meeting with an easing bias and we had to take that easing bias out, the risk-reward skew for the ECB and the BOE is probably the opposite. The market has some material hikes priced in for both of those economies. Our concern and risk at Morgan Stanley is that the growth risks are underappreciated or underestimated in both those economies. We've already downgraded European growth by 40 basis points, moving from around 1% to around 0.5% this year. And though inflation is clearly a risk, and the pass-through from headline to core in the euro area and the UK is actually very, very material, conversely, the growth risks are also quite material. For those of you that follow the euro area closely, the services PMIs fell precipitously in the last meeting and were well below consensus. And that was before you even started to see an effect in the manufacturing PMIs. We would expect that lower March in PMIs to continue. And at some point, the growth risks have to weigh. So for the ECB messaging, we're not going to get a decision today. We still, in line with market pricing, have a hike in June. But I think the point is that the risk-reward skew there is a lot more towards growth risks down rather than inflation risks up versus market pricing, which is the inverse of what we saw from the Fed yesterday. I think that the balance of how the oil supply shock affects different economies is very different geographically. Europe is the most exposed here for a number of reasons. The US, as we know, can absorb this. The US does not have a lot of transmission of oil supply shocks into core inflation. It mostly transmits through disposable income and temporary softness in consumption. And the United States has a lot more energy independence than does Europe. In Asia, there is a lot of imports for energy, but the difference is that central banks don't have to react as fast as the Europeans, because the Asian economies use a lot of smoothing mechanisms, whether it be subsidies or average pricing controls, to ensure that the price pass-through is not as material. So Europe becomes the real epicenter of a lot of the oil shock and how it's going to play out for central banks in real time. And so that's why the ECB and the Bank of England are in a larger predicament. And that's why I think the comments today will be really important. Like I said, we have a hike in for the ECB in June, but the risk-reward skew relative to market pricing is that the growth concerns start to become more clearly communicated, if not at this meeting, in the near future as data misses. I will stop there and hand it back to Crystal.
Thank you so much, Rajiv. That's super clear. And then before we go into any questions, maybe I will just introduce the next topic here. Even though uncertainty still weighs on sentiment, but then our Asia economist team, they are seeing an industrial upcycle underway. Keaton, can you just maybe talk us through of the key drivers behind this? Hey, Keaton, we can't hear you yet.
Yeah, apologies. I forgot to unmute myself. So thank you for having me, Crystal. So I'm going to focus on the Asia industrial supercycle story that we just published early this week. I know that at the outset, I wanted to address the oil price issue and the geopolitical developments as to how does that impact the story. So, look, I think the way we are thinking about this is that it is going to have a negative impact in the near term. And in fact, our team in Asia has already cut their growth forecasts for second quarter. And then we have some lingering effect in third quarter as well. But beyond that, we are assuming that this oil price related tensions would have been taken care of. So in the near term, it will affect the sentiment for business capex as well. But as long as the situation is resolved, we think that the structural forces are so strong that this recovery in industrial capex in the region will come back. So with that, let me just share the charts and the call that we're making there. So we're expecting that Asia's investment, which is currently at about 11 trillion, will rise to 16 trillion by 2030. And there are four structural drivers to that. Number one, it's AI and AI-related infrastructure spending. Number two is energy and energy transition, which now with this development in the Middle East has become energy security spending. And defense, which again, everybody had been planning for increasing defense spending before the Middle East tensions, but now we reckon that they will be quite more serious about increasing defense spending as well. And within defense spending, we are sensing that it's really the equipment component which is rising. And so that matters for the capex cycle. And then finally, as you tend to see this capex recovery, what we see in Asia is that it is not only feeding its own domestic capex requirements, but it is also feeding the capex requirements of the other economies in the world, which are also spending in these same areas. And so you tend to see a broader capex cycle, industrial capex cycle in Asia. Because of the supply chain related linkages of these structural areas of growth domestically as well as within Asia as well as globally. So those are the four drivers. Now, just in terms of additional numbers, so the overall numbers are growing at 7%, as I mentioned, from 11 to 16. But the high growth segments that I just mentioned are growing at even a faster pace. So the four combined structural driver spending is going up from 5.5 to $8.7 trillion. So that's a 10% CAGR in terms of in dollar terms. And within that, if I exclude the broader industrial capex and just zoom in on the first three segments, which is AI, energy transition, and defense, that's rising even faster from 1.8 trillion to 3.7 trillion. So that's the component story. Just a few charts to highlight how this story is actually panning out and what is the high frequency data points telling us. So we focus a lot on this capital goods imports trend, which we compile from looking at trade data for every country in the region. And then we aggregate that for Asia and for global. And as you can see, that Asia story is even stronger than rest of the world. And we found historically this tends to be quite correlated with the GDP component of capex. Sometimes there is a bit of a lag, but more or less it follows. And you can see the chart on the right-hand side. The yellow line is the GDP component of capex. And this, the yellow line is up to December quarter only, but the high frequency data points are showing that first quarter GDP component data as it comes out, you will have seen a further pickup in capex as far as the GDP component is concerned. The other idea I had to explain today is to give you a little bit of a rundown of each of these components. So as far as AI and AI-related infrastructure spending is concerned, we have the data from our team on AI part, and that is going to be growing quite strongly, as you can see from this graph, from $0.5 trillion in 2025 to $1.1 trillion by 2028. And as we've seen in the past, when there is a pickup in global IT capex, but in this chart we have just US, but it should be the case for the whole world. As that capex picks up, Asia's exports follow, and it is quite correlated. So as I was mentioning earlier, when there is this capex in each of those segments globally, it helps Asia with a double boost because it is exporting those capital goods, and at the same time, it is going to feed that for domestic capex. On energy, we think that this is going to be a big area within the region because of the developments that you've seen in the Middle East. There has been already a lot of announcements from several governments in the region that they are going to increase energy-related spending. And we think that this is going to benefit everybody. Everybody has some exposure to energy transition in terms of exports, and everybody is going to do more spending on energy-related security. China will have the most benefit from exports, and as you can see from the graph here, there was some slowdown in China's exports in these segments, which is EV, solar, and batteries. But then in the last 6 months, we have already seen a big pickup. And this is, it's got March, which has the benefit of Middle East tensions effect reflecting. But we would reckon that this would go up even further quite meaningfully from here. So China is going to get a significant boost in its exports on account of this energy-related exports, but also because whenever there's a broader capex cycle, China is the industrial powerhouse in the region, and so therefore they will also see the benefit more broadly beyond these three categories. And then finally, the third one was on defense. As I was mentioning earlier, the forecast that I have, or target numbers that I have here on the left-hand side chart for few of the economies in the region which had already articulated their targets were there before the tensions emerged in Middle East. And as I was mentioning earlier, we think that now there's a higher chances of these numbers and targets coming in through. For India, we don't have a medium-term target, but for 12 months ended March 27, they have already indicated an 18% increase in the capex component of defense spending, which is what will really matter for our story. So we are seeing a more broad-based increase in defense spending as well. And then finally, just to conclude, which are the economies that benefit in the region? So it's Taiwan, Korea, China, and Japan. But if I were to sort of think about exports and kind of breadth of all the sector exposures that I listed earlier, I would say it's Korea, China, and Japan. And then India is also benefiting, but it is more primarily on the basis of the strength in the domestic capex cycle. India had already seen a pickup in its domestic demand. It has had the maximum, if you call it, fiscal and monetary policy easing support and tailwind going on in the region. And so therefore that will be the story for India as well, but just more focused on the domestic capex benefits. So with that, let me stop here and hand it over back to you, Crystal.
Thank you so much, Chetan. And next we have the implications on the equity market. And then our team have published a report on the debate around whether EM is a secular bull market or still a cyclical market. And then today we have Jonathan here to share his thoughts here. Over to you.
Yes, thank you, Crystal, and hello to everybody. So we wrote a foundation report, a long shelf life report on EM equities, an asset class that I've covered for almost 30 years now, and which is enjoying a very strong period of cyclical performance. However, we argue that this is unlikely the beginning of a new secular bull market, such as we enjoyed, for example, in the first part of this century, the early 2000s. So if one summarizes the report, and then I'll go through some of the charts. There are strong arguments to look at EM, diversification ex-US and negative correlation to the dollar. But working with our cross-asset team led by Serena Tang, we demonstrate in the report that there are ultimately other assets that can do the same and with better Sharpe ratios. Secondly, EM in aggregate lacks a macro-micro narrative. It's very different from Japan, where we have the reflation story and the ROE and productivity journey. And in fact, in the multipolar world era, there is no longer a broad EM to DM convergence process that this group of countries are following. There are major issues around geopolitical risks and stock concentration, and that's a big problem for passive strategies investing in the overall EM index. And though we are really enjoying the rising IT and semis weight, and obviously Chetan's industrial cycle view, and implementing that in our focus lists, we do have the underlying problem of earnings cyclicality remains. It's a uniquely cyclical asset class in relation to earnings. And valuations, finally, are high to history and fundamentally unattractive versus DM, such as Japan, from an ROE versus cost of equity perspective. So that's the pitch. So let's just quickly look at some charts, and hopefully you can see this here. If you look at the actual breakdown by market, as of about a week ago, Taiwan has overtaken China. So we essentially are dominated by four large markets. In that sense, it's not a diversified asset class. And over time, it's had a very wide skew of weights by market. If you go back, for example, to 2007-8, Brazil was briefly the largest market in EM. Russia obviously was important in the past. And China itself peaked at 43% of EM in 2021, and it's come down considerably in weight recently. And over the last 18 months, India, which was for a while the second largest market in EM and had looked like it was converging with China, has had a dramatic fall in weight and is now down to only 12% of the index. If we look at the whole issue about a shift to multipolar world, again, given the time constraints, I won't belabor the point, but this chart on tariffs, and Rajiv was talking about trade and tariffs earlier on this webcast, it just shows the regime change really from 2018 onwards. We're no longer in a world where multilateral institutions are driving forward common agendas. around reducing, let's say, tariff barriers, opening to trade, promoting global capital flows. We're in a highly complex environment for multipolar world dynamics. We're beginning in 2018, accelerating through the COVID pandemic, and now the second Trump administration, last year's Liberation Day tariffs, and obviously this year's oil price shock. If you just look at the various macro fiscal indicators, external indicators, and political indicators on this summary exhibit, what really leaps out is just how heterogeneous the group of countries that are in the EM index are across multiple metrics. So there's simply no commonality here whatsoever in this group of countries. If you look at the portfolio arguments for diversification, yes, EM is a large alternative asset class, about 12% of ACWI, as you see on this exhibit, and it does have a negative correlation in performance relative to the dollar, and that was a big tailwind last year, less of a tailwind this year, and probably on a go-forward basis. But crucially, in this part of the report, when we actually look at these Sharpe ratios and how one should think about an efficient frontier portfolio for an asset allocator, Exhibit 11 on the left here shows that just adding EM equities does nothing for your efficient frontier. It has a high beta, and yes, at times there's alpha, particularly at the stock level, but there are other ways to get to a better efficient frontier for a global investor than adding EM in equities. Specifically on Exhibit 13 here on the left, adding EM dollar credit. And this is a point we have made in the past, and Serena and the cross-asset team as well, or indeed Simon Weaver and our group that look at EM as sovereign debt. This actually diversifies the portfolio better. Or on the right, if you add copper, and this is a look back for 10 years, that has diversified the portfolio better. So from an asset allocator perspective, this is not a great asset class to be thinking of in terms of structurally adding to weights. Yes, there are capital market and governance reforms ongoing in EM, particularly in Korea, but they're in general far larger and stronger and more persistent in Japan. So you can see, for example, on an exhibit like this, activism engagement activities, the blue bars here for Japan really sort of dominate the chart. We do have ongoing activity in South Korea in green here, and continued relative high activity in Australia, but the rest of the asset class is really not participating in this story. And in aggregate, a key weakness of EM continues to be dilutive equity issuance. So the red line here. EM companies, brutally speaking, are very good at issuing equity when the stock prices are high, but not so great at capital management over the cycle. Whereas the change that we've seen on the green line is that Japan has changed fundamentally. And in fact, if we look at net equity issuance, it's a far better story. And if you look at dividend payout ratios here, EM remains very low, and Japan is much better. So just on earnings cyclicality, if we just look at benchmarking EPS back to 2006, EM is the laggard. The improvement in earnings growth is clearly in the US and in Japan. Now, for sure, this year will be stellar for EM earnings. We may get something like 40% plus year on year. But it's extremely skewed, as we'll see in a minute, to semis and IT. If you look at the variance of EM earnings, it's far, far more volatile in terms of EPS than the global equity universe. And EM in aggregate does have a sensitivity to the crude price, and demonstrated that in performance in March, and is likely going to demonstrate that for large parts of the asset class facing the consumer and downstream industries, as we are now going through a second and likely, in my view, far more elevated sustained period of high oil price over the next few months. Something we've written pulses about in the last couple of days. And that's for the very simple reason that the asset class is overwhelmingly oil importing and gas importing. A lot of the future hinges on China and India. Can they, I guess, sort of get their mojo back in terms of delivering sustained EPS growth? We've been systematically more cautious than our competitors on that in relation to China, which is why Laura and the team have focused on stock picking. And India is struggling at the moment in relation to earnings. So the concentration is spectacular, as I mentioned, 80% plus in just 5 markets, but probably less well understood is just how concentrated by industry this asset class is now. If you look at semis and IT, that's up to almost 35% of the asset class. It could well be 40 or even 50% over the next couple of months. In that sense, again, and this is rather like the point about diversification into other asset classes, if you do want to engage in semis and IT and memory, sectors that we are broadly constructive on, why not just buy the stocks? Why have this exposure to an overall asset class rather than the stock exposure? Rather than going to the stock exposure if that's what you want. So EM's top 5 stock exposure is by far the highest of all the major indices, roughly double that of Japan. In other words, it's not an asset class story that's going on here. It's a very, very, very skewed sector and stocks story. I'll probably just focus briefly on valuation. So we did on vanilla PE get to 2 SDs expensive, then dropped off. But on Schiller PE, we remain very expensive, and that does a much better job of predicting 3-year forward returns. And so the answer, in our view, is to pick stocks, ultimately. And our 20-stock EM focus list has delivered significant alpha, over 300 basis points per annum of alpha versus the index, going back for 20 years now. And this concentrated approach, trying to get the themes right, to understand which sectors are currently working, which stocks are working, is the right approach ultimately to EM equities investing, not buying a purported asset class that no longer in fact really exists. So do check out the EM focus list, do check out the style bias towards quality in our best business models approach. And with that, I'll close my remarks and hand back to you, Crystal. Thank you.
Thank you so much, Jonathan. And last but not least, we have Show today with us as well. We're in the middle of the earnings season, and then Show, can you share with us what are the companies guiding, and then what's your playbook on the equity side?
Sure. Thank you, Crystal. Actually, we've been receiving a large number of inquiries from both domestic and international clients regarding Japan corporates' guidance risk stemming from the situation in the Middle East. In response, we conducted an analyst survey covering our stocks under our coverage, focusing on 3 key dimensions. So first, transmission channels of the Middle East situation. And second, the degree to which risks are already priced in the market. And the number 3 is how analysts assess guidance risk. So in this perspective, the survey results first show that at this point, analysts tend to view the impact of the Middle East situation less as direct supply chain disruptions and more broadly as cost inflations. If you look at Exhibit 8, out of 479 corporates surveyed, cost increases were cited most frequently. This was followed by indirect impacts, supply constraints, demand slowdown, and logistics constraints. This suggests that analysts are focusing not on a complete halt in supply chains, but rather on margin pressure driven by cost push factors. In the free text responses, concerns are centered on margin compression resulting from rising prices of naphtha, petrochemical feedstocks, resins, fibers, rubbers, coatings, housing equipment, and packaging materials as well. Then key question is how much of this Middle East related risk is already reflected in earnings guidance and share prices as well. In this regard, based on analyst views, we mapped cross-sector level robustness and vulnerability as shown in this Exhibit 13. X-axis represents the number of risk factors associated with Middle East exposure, essentially a measure of sensitivity. The farther to the right, the greater the passive negative impact. And Y-axis reflects the passive impact on EPS, the extent of pricing in its share prices, and the effect on guidance as well. So the higher NAP, the less problematic the situation is considered. Accordingly, sectors positioned in the bottom right are the most at risk, while those in the top left is relatively more defensive. So from this framework, the most risky sectors appear to be transportation, energy-related sectors, and transport equipment like autos. Analysts believe these sectors have yet to fully price in guidance risk stemming from higher costs. In chemicals, while cost inflation remains strong, much of this appears to be already priced into share prices. So this suggests there may be opportunities to selectively take long positions in names that have been oversold. And construction shows relatively low sensitivity to these risks. And pricing in has also progressed. The sector moved higher earlier this week for earnings from a subcontractor name. And our construction analyst believes that if upcoming corporates deliver solid guidance, there's still room for further upside as guidance risk is gradually priced out. And using these sector level insights as a starting point, we conducted a screening as an individual stock level by combining a robustness score with share price momentum. Stocks with high robustness and strong momentum showing Exhibit 15 should maintain a long bias because these include AI-related names such as memory and electronic components, as well as materials and specialty chemicals. Majority of investors are still holding really strong long bias on those sectors, which is consistent with high robustness regarding the Middle East situation. At the same time, stocks that are resilient to Middle East risk but have been sold off, Exhibit 16, include general contractors, subcontractors, and diversified chemicals. This could be accumulated with a view to rebound around earnings. On the other hand, stocks with low robustness and weak momentum in Exhibit 18 include autos, real estate, airlines, and consumer staples. These remain the core of a bearish positioning. And finally, stocks where share prices have been relatively robust, but guidance risk remains a concern in Exhibit 17 stocks, mainly in transportation and utilities. Here, we would prioritize reducing its positions. So overall, this is a key message emerging from our latest analyst survey. So I'll stop there and hand it back to Crystal. Thank you.
Thanks very much, Joe. And now we are moving on to the Q&A session. There are two questions from for Chaitan, basically. So this is on the energy security side. And then because you mentioned that energy is one of the major drivers behind the Asia industrial cycle. So which segment may receive the most headwinds? Is it the upstream oil and gas or coal, or is it among the renewables, whether it's nuclear or wind and solar, and how do you view the capacity issue? And then the second question is how do you weigh the risk from demand side from here?
Yeah, so it's actually more to do with all of the segments, but it depends upon each country. So, but if I sort of look at on an aggregate basis in the region, it's the biggest focus is on renewables. It is something that all the governments were doing. But more of them will have to now do it, and they've already made the announcements related to that. Some of them who have coal, for example, China, India, and Indonesia, they are going to focus a bit more on thermal. They had been, but the two reasons for focusing on thermal back, number one is that this whole geopolitical tensions have reminded them. The second is that it's also when you are taking up renewables investments aggressively for stable state electricity supply, you do need some thermal. So they're all also coming to that realization. China had already realized this and had therefore kept enough of that thermal capacity, but the likes of India are realizing it now and are going to refocus back on coal. There are efforts on nuclear, but that is a bit of a slow-moving target. So in the near term, they are going to focus more on renewables and coal. Now, from a demand perspective, it is, as I mentioned earlier, that there is going to be some dent in the confidence, and maybe there is some pullback. We haven't seen any high-frequency indicators showing that. as yet, but I suspect that if oil prices continue to stay high, there will definitely be an impact on capex as well. But the way I was explaining earlier is that in the past, if you would have seen an oil price kind of development, it would have the cycle would have taken a bigger hit. But because there are structural drivers behind this cycle, we think that as soon as the tensions are resolved, this capex cycle will come back with vengeance because of the factors that I mentioned earlier, that Middle East tensions actually increases urge to spend more on energy security and more on defense.
Super clear. Thanks so much, Chetan. And then next we have also two questions for Shou. So because we just had the BOJ meeting, and then how should we interpret the messaging, and then what are the implications on equity side? And then the second question is that because yen has already moved past 160, so should we be concerned about the FX intervention risk from now?
Sure. Thank you for that question. The overall takeaway is quite clear. The BOJ has a strong desire to continue raising interest rates. Some investors I discussed after BOJ meeting viewed it as a surprise that board member Nakagawa-san casted a dissenting vote. But from a strategist perspective, the most striking point was a subtle but important change in the policy language. In March, the BOJ stated that it would continue to raise the policy rate in line with improvements in economic activity and prices. But in April, the phrase improvements in was removed. This change can be interpreted as a signal that if the upwardly revised inflation outlook materializes, the BOJ is willing to proceed with rate hikes even if the economy shows some weakness. That is a notably hawkish shift. That said, whether a hike can actually take place in June will likely depend on developments in the Middle East situation. As the June meeting concludes on the 16th, which is close in timing to the government's release of its basic policy framework, raising some uncertainty around the coordination with the Prime Minister's office. In addition, it is still unclear whether risks such as supply chain disruptions, something the BOJ does not appear to fully incorporate at this stage, can be safely ruled out. So given these uncertainties, I personally believe that there is no need to strongly price in June rate hike at this point. So from top-down perspective, we find it is difficult to maintain an aggressive overweight position in bank stocks. Regarding dollar yen, which has moved above 160, but I do not think there will be intervention at this level. I feel many equity investors maintain a view of gradual dollar strong yen weak buyers, because the recent rise in dollar yen following Middle East developments has been driven primarily by dollar strength rather than yen weakness. The yen itself has not weakened materially. Looking at speculative positioning, yen short positions have not expanded meaningfully. In that context, even if there were intervention, it would likely be largely ineffective. At the same time, not only crude oil prices, but also naphtha and fertilizer prices are rising. This points to higher headline inflation and the likely widening of the trade deficit in Japan. As a result, Japan's real policy interest rate would become even more negative, which should make the yen relatively weaker.
Thanks, Shou. Actually, just a very quick follow-up question here. How do we compare the current dollar-yen carry trade level? Because you mentioned that it hasn't really meaningfully come up, but then how does it compare to August 2024 level that we've seen 2 years ago?
So yeah, in the comparison with 2024, the level is much less in the current situation. I think the amount of the yen position is a kind of one half. Comparing with 2024 or May to summer level. So from a fundamental perspective, dollar yen could move higher from here, but upside is being capped by uncertainty over potential action from Finance Minister Katayama-san.
Got it. Thanks so much, Shou. And in the interest of time, we'll conclude today's session here and answer the remaining questions offline. Thanks so much for joining us, and do reach out to me and the team if you have any other questions. Have a nice day and see you next week.